This type of mutual fund primarily focuses on bonds. Investors often choose this option because it's relatively low cost, which allows to easily build a diversified portfolio. You can include different classes of bonds with different maturity: investment grade, corporate, junk, government, sector, international, gold, and precious metals. Generally, there are two types of bond funds. Government bond funds buy government securities, treasury bonds, agency securities like Freddie Mac or Ginnie Mae. Usually government bonds are considered risk-free because they're backed up by the country. These funds guarantee their investors a stable income in a relatively safe environment. It's valuable to know that, in contrast to safety they offer, there's a minimal opportunity for capital gains. Municipal bond funds, also known as tax-free or tax-exempt, invest solely in municipal bonds. Their type depends on the objective of the fund. What they offer is a return free of federal taxes. And if an investor is a resident of a particular state, they're also exempt from state taxes. The opportunities these funds offer are quite limited. Usually, this opportunity is preferred by people who live in states imposing high taxes on their residents: New York, California. Now let's discuss the risks associated with bond funds. There's always a serious risk of a borrower to default on their debt, which means they can keep up with their payments. This is defined as credit risk. It depends on the borrower's credit rating. According to this, U.S. Treasuries pose a little risk, while corporate bonds are not as safe and predictable. Having bonds in mind, we have to consider interest rates. The basic rule is simple: if rates go up, the value of bonds go down. There is a strong and unbreakable connection between bonds and rates. Keep in mind that the longer a bond's maturity, the greater the risk. Nevertheless, compared to stocks and their prices, bonds are not as inconsistent and volatile. There is another risk associated with bond funds: prepayment risk, and it's closely connected to movement of interest rates. If they go down, the chances are that a debtor would like to preliminarily pay off their debt, which accordingly causes loss in interest on the bonds. That's it for now. I hope you enjoyed, and don't forget to subscribe to our podcast channel on YouTube. We'd love to know your thoughts, so feel free to share them on the comments below.